Dan, welcome to the show.
Thanks, Matt. It's good to be back.
It's been 2 years. My God, nothing's happened in the meantime. There's a pandemic.
A global pandemic, other than that, not much.
You replicated at least once, maybe twice with children. You're in a new house, moved cross country. My God, man. It's great to have you.
I know. It's been a crazy 2 years. Well, it's great to be back and great to get a chance to catch up with you, Matt.
Why don't you tell us a little bit about what's been going on? We're going to talk about all things crisis in a minute, emerging markets, two of my favorite topics, but also with people I'm sure that loved your first show. We'll add a link to the show notes. Episode 90. You're in the first 100.
Oh my gosh, that's awesome.
Yeah, we were talking about private
and issue some sort of coin.
Yeah. Oh, God. That's 2021 for you. All right. So last time we had you on talking stocks, talking private equity, all that world. You're trying to disrupt it. Your firm was sort of in its infancy. Walk us forward. What's been going on?
Yeah, well, we've grown a huge amount since 2018. So, we're nearly 600 million in assets under management. I forget where we were in 2018. Maybe we were at 50 then. So it's been a sort of rocket ship ride up, which has been great. We've grown the team.
Way to go, Meb Faber Show podcast listeners. I attribute at least 500 million of that to our.
I attribute it to the podcast as well. But so it's been a lot of growth, which has been great. And the firm has grown, and I think on the other side of things, we've dealt with a pretty rough period in the equity markets, right? So, as you remember, sort of our thesis behind private equity replication was that the core driver of private equity was buying, micro cap deep value, and from 2018 through Q1 of 2020 was, if not the worst time ever to do micro cap deep value. I mean, you just couldn't go right. And the smaller the company you bought, the cheaper the company you bought, the worse you did, which was enormously stressful for me. And I think that what we focused on trying to answer in that period is our analysis wrong? Is our empirical work wrong? And we kept coming to the conclusion that it wasn't, right? That there was just something unique going on in small cap value, relative especially to large cap growth, just done really, really well. And started to think about, okay, well, when, how do we think about when small value works, right? So if we started, when I first started sort of uncovering this idea, right, you sort of think, okay, small value, you discover it for the first time. You say, well, this is genius. It's the best strategy, or it's the highest returning strategy. And gee, micro cap and deep value, right? The more you load up on those factor exposures, the better you're going to do, right? And any back test you do over a long period of time tells you the exact same thing. And yet from 2018 to 2020, Q1 of 2020, right, you're just getting told by the market every day that that's wrong. So what I started doing work on, or sort of asking myself, and especially coming from private equity, right, where, you can make up your own marks for 2 years. So you don't have to discover you're getting whacked, right? So you can just ignore it completely. But in the public markets, right, you see that day-to-day vol. And you're dealing with that company that was number one ranked in your quant model that just went down 30% or something, right? So you have to reckon with it and say, well, when does small value work? Or during the 2018 to 2020 period, when will it work again? Because it's not working right now. And that led us to sort of trying to relate how the macroeconomic environment relates to the performance of small value. And we're going to get into some heretical ideas around market timing, right? So we're getting on in some dangerous ground that I know some people object to. But the question is, are there times when small cap value is more likely to work than others? Are there economic periods when it's less likely to work than others? And how can we kind of explain what's going on? And the research we started doing, and what's really driven our firm's growth, probably the majority of which has come since March of 2020, we basically found that small cap value dramatically outperforms coming out of a recession. So if you buy small cap value in a recession, your odds of the small cap premium or the value premium or both working go up dramatically, right? There's academic research that says actually those factors are 8x more predictable in times of crisis. And the simplest way to define a crisis in small cap value world is through the high yield spread. So high yield markets, right? So high yield issuers are small. They're issuers of debt, so they've got some issues. And so the high yield spread goes above sort of 600. We sort of define that as a crisis or a recession.
When you say high yield spread, what are the two metrics you're kind of measuring?
Yeah, sure. Sorry, the high yield spread is the difference between the rate that high yield borrowers issue debt at and the underlying treasury rate. And it's adjusted for duration. So, think of a normal spread as sort of 350 bips or something like that. One standard deviation above normal would be 600, right? And, if you think of where we hit in March, it was, well above that. But we basically said, look, if you think about why that happens, right? What the high yield spread is measuring is a few things. It's measuring lending. And as it's measuring lending, that's also a proxy for equity investing, right? If no one's lending to these companies, then no one's buying their equities either, right? So they're getting starved of liquidity. And if you think that the small cap value premium has anything to do with liquidity, this is telling you that the liquidity premium has just gone up massively. And the risk of default, which also could potentially be driving this, has gone up massively. Right? And then the other thing is that the high yield spread is a really good contemporaneous macro indicator. So it's telling you with a pretty high degree of confidence the economy is in a recession. If the high yield spread is over 600, you're pretty sure you're either in a recession or in a quasi-recession or an industrial recession or some type of recession. And what that sort of, as we sort of peel back the onion, right? You sort of say, okay, a high yield spread is indicating a liquidity, it's indicating a lack of market optimism about, or a severe amount of pessimism about these types of companies. And when you think about, so that's driving your sort of liquidity or size factor. And what's going to drive your sort of value factor in those periods is the recession. So if you think about now value stocks, right? What are most value stocks? They're industrials, they're consumer discretionary, there are a lot of financials, right? Well, what happens in a recession? Well, consumer discretionary spending plummets, all the factories stop producing things, and interest rates drop because the Fed takes rates to zero. So who gets whacked? Well, cyclical consumer discretionary companies, industrial companies, and banks, right? Which is basically the small cap value world. Well, what happens after a recession? Well, if GDP was down 5, and that meant that the industrial manufacturing sector was down, 20 in terms of revenue or profit or whatever, right? Well, to get back to even, right, you're going to have massive rebound in earnings, right? And interest rates are going to go up, and the banks are going to benefit, and the cyclicals are going to benefit. And so you're going to have this, and the value stocks, right? At those moments, you're buying into value at a time when earnings are at trough. And so if you're buying into those companies with trough earnings and at low valuations, you're actually paying less but getting way above average growth, right? So usually value stocks see declining growth or flat growth relative to growth stocks which actually grow. But in a recession, it's reversed, right? So the one time you see like some crappy auto parts manufacturer grow faster than Amazon.com is like Q1 of 2020 through Q1 of 2021, right? When you see that sort of growth value dynamic. So what we started talking about really actually probably as early as 2018, I bet if we went back and do a transcript search of our conversation, the high yield spread came up. But we started talking about and saying, look, small cap value and private equity replication is a great buy and hold strategy for the long term. But if you're trying to time it, and if sort of short-term results are important to you, what you want to do is buy in after a crisis when high yield spreads have blown out. And basically ride it out until the economy normalizes. So what we've really been focused on, I'd say, since 2018 is grappling with volatility, grappling with market timing, or at least trying to think about when factors work and don't work, dealing with sort of the quant apocalypse of Q1 18 to Q1 20, and really doing a huge amount of work on this idea of crises, how to invest in crises, how crises work, and why crises are sort of uniquely special times for especially factor-based investors, but I think for all investors, because I think it's a really, really important thing, and it drives so much of investor behavior, and I think it's been understudied.
Well, like you mentioned, I mean, this paper came out when did you guys first publish this one? And we'll add a link in the show notes, listeners, on crisis investing.
So we published that, actually. It was done in January of 2020. I think we published it the early February of 2020.
I thought so. Amazing. Well, I mean, it's kind of played out that way, right? I mean, you had small cap value, looking at some of the metrics, got absolutely nuked in Q1, and then have had this just amazing run since. And it depends on where you want to put the sort of peg of when that world has shifted. And it seems like a big regime shift to me. Not a lot of people, I don't feel like still appreciate the kind of tide shifting. Walk me through it. Did it play out like you guys wrote about in the paper? Was it a little bit different? Because those spreads sure did blow out.
Yeah. So basically, we had this whole thesis, right, which is that in a high yield crisis, if you buy into small cap value, the smaller the companies you buy and the cheaper the companies you buy, the bigger will be the rally when the economy recovers. Now, you don't know when the economy is going to recover, right? So you don't know how fast the rebound is going to happen, but with a really high degree of confidence, much higher than normal, you can guess that there's going to be a size premium and guess there's going to be a value premium. And what you saw in this recovery, initially, I'd say, let's say March through October, what you saw was a size-based recovery. So small caps started ripping. But it was growth that was leading, which is really weird, right? I mean, you don't, that's not a normal thing. Size rips, but it's weird to see growth leading, but growth was really leading through October. And, what do you attribute that to? I think, I would say, I think there's some elements of a bubble in some of the small cap growth world. I think there's some elements of euphoria. I think it's pretty scary, but that's abnormal. But size was working, right? So anyone that bought small value, you were benefiting from the size effect, even if you weren't getting any juice from value. And then November, the vaccine was announced, and value just has taken off. And it has been, I think, this exactly what we have predicted. And I think it's all around, again, what we wrote about in that paper was, first, you have the liquidity flow back into markets, right? And that is really, obviously, what's going to drive a size premium. And the smaller the company, the better. And that's played out too, right? Micro caps have done better than small, small's done better than mid's done better than large, right? Just sort of a perfect factor, just as you'd expect to see based on our research. And then where you start to see value playing out is when you start to think about, okay, what are 2021 earnings going to be like, right? And then you start to do the math, and you're looking at these auto parts companies or these, I mean, you name it, a paper packaging company or a company that prints signs, or right, these boring old world things that just nobody cared about for especially 2018 through 20, when everyone was talking about disruption and blah 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 blah, right? And all of a sudden you're looking at the earnings forecast and you're like, wait, do I own Amazon or Facebook or something, right? This thing is forecasting a 30% year-over-year revenue jump. And you just realize it's like, oh yeah, the reason everyone was avoiding small cap value or why multiples were compressing is they were worried about cyclicality and GDP exposure, right? And so you just got paid off in a big way for avoiding small cap value in March of 2021, right? If you just said March 2023, you just said, hey, small value sucks, I'm staying out of it, I'm gonna stick to large cap growth, right? You got paid because you bet that cyclical stuff was gonna get whacked at some point, and it did, so you were right. But the reversal of that is what so many people missed, right? Because the good thing about cyclicals is when the cycle turns, their earnings turn. And the GDP linked goes from being a bad thing to a really good thing. And that's the regime change we're seeing now. And I think the other thing that's worth noting is that, we are, I think we spent years and years studying this to kind of come to this conclusion and lay out that thesis. We're delighted that it's proven right, and delighted that it's happened that way and it's worked out that way. But I think the other thing that is sort of worth reflecting on here and thinking through, right, is that there's so much more room to run, right? Because what a lot of investors do is they're not sort of forward looking. They're not saying, oh, great, Q1 of 2020 looks exactly like these 8 prior crises over the past 50 years. They're saying, hey, what worked over the past year or over the past 3 months? And I should get me some of that, right? Like, wait, you're sitting on your investment committee, you're asking your consultant, it's like, hey, well, why are we underweight small cap value? And that's been the best performing thing. And they say, oh, well, we can fix that. Let's hire a new small cap value manager, right? And let's move some of the money from what's underperformed, which is large cap growth, into small cap value. And all of a sudden, your trailing liquidity flows start to rush in. And so I think these regime changes tend to, they have some sort of feedback loop component to them. So I'd say that regime change, which I think started in November and took a lot of people by surprise. If you read our paper, not to boast too much, you wouldn't have been taken by surprise, because I think this is something that happens after every crisis. But that is a long ways to run. Our research would say you've got probably 2 years when those factor exposures just sort of run. Before you're sort of back to normal, unless you have some sort of double dip or another crisis, right? We get hit by some other pandemic, right? A year from now, then forget my 2 years thing. But I'd say from a sort of base rate perspective, these things build on themselves. They have a feedback loop element to it, and once the party gets going, it tends to last for a little while. And small cap value has been so beaten up for so long, right? That gee, just to get back to normal with the S&P 500 or break even with the S&P 500, we've got a lot of outperformance ahead for small cap value.
Well, good. I agree with you. And listeners, the Verdad team sign up for their email list. We'll add a link. They dribble out once a week, I think, research pieces over time. So I've been reading these over the past few years on all sorts of different topics, including bonds. And we'll get some more ideas in a minute. Dan, what has the reception been for you guys in the institutional community? Because if I was CalPERS or an endowment, and read a lot of your early research on private equity replication and within the public markets and what y'all are doing. Not to give you a softball, but it's kind of hard to argue with, in many ways. But to me, it seems like such a thoughtful approach. What has the discussion been like as you've had conversations the last few years, as you continue to talk to allocators about some of the ideas there? Are they receptive? What are sort of the struggles they have with thinking about this approach? Is it career risk involved? Is it the structure of having a 10-year lockup in private equity? Just give me a little color on your discussions the past few years.
Yeah, sure. So I think there's, and coming on this podcast has been a part of it, and writing about this has been a part of it. But I think there's been a shift, a definite shift in the way people think about private equity. I think, there's still a lot of boosterism about private equity. I think every booster is also aware of the counter arguments now, which I don't think they were 3 years ago. I don't think they understood the liquidity risk. I mean, I think maybe they understood the liquidity risk, but the leverage levels, the valuation risk, really what was kind of going on a deal by deal basis. I don't think people were well informed.
And where do those, by the way, not to interrupt you, but where do those stand today? Are they similar to where they were when we first talked?
Much
Are they
worse.
getting worse?
So it's sort of funny, right? I mean, I think that one of the things that's happened, and that I wrote about last year, but you had this shift right after the financial crisis where regulators came in and they said, okay, we gotta clean up bank balance sheets. And there's been some really interesting writing about this, right? But banks have always been sort of like, they've turned into utilities, right? So much of the risk has been taken out of bank balance sheets, right? All the crazy things they were doing, right, in 07, 08, they're just not allowed to do. And there's sort of a good reason for that, right? It blew up and it was bad. But one of the things they stopped doing, or virtually stopped doing, is private equity lending, right? The regulators took a look at that and said, hey, gee, this isn't worth it. And the banks took a look at it and they said, gee, we haven't really made that much money here. The default's been really bad, right? This, this seems like, let's focus on something else. And there emerged this new industry called private credit, which is actually a pretty hot thing. And private credit basically, started with like KKR or Blackstone or all these firms just opening a credit arm that would lend to other private equity firms when they did deals. They'd say, why should these deals are so good? Why should we give away the lending to the banks? Why don't we create our own lenders and we'll lend to PE? And those private lenders, which had money from endowments and foundations and insurance companies, had none of the regulatory, scrutiny that the banks did. And so have been able to innovate, right? And there's always something one worries about with financial innovation, right? There's just two words that you get a little bit worried about, right? You sort of like, this is the reason why old insurance companies used to be built with and banks built with Greek columns and built out of marble, right? They were sort of saying, we don't innovate, right? We're going back to the Greeks, we're trustworthy, we're safe, it's a Roman building, you can trust us. But financial innovation is obviously in vogue these days in a number of places. But these private credit firms had, much lower standards than the banks. And because they were run as funds, they had a tremendous desire to deploy capital, get deals done relative to banks, which might have had other lines of business. And so the arrival of private credit has pushed leverage ratios, EBITDA adjustments, just to kind of crazy levels. Now, the good part of that for the sponsor is that in their marketing deck, the private credit firms say, we haven't had any defaults. They don't want to have any defaults. So anytime the private equity firm would have defaulted, right? They trigger a covenant, things are looking bad. The private credit firms just renegotiate. They say, hey, we're not going to put you into default, but we're going to extend number 10, we're going to change the terms, we're going to give you a loan, interest forgiveness. And when you look at adding those sort of adjustments back in, private credit sort of looks like triple C type debt or even worse. But that has fueled the private equity boom. So you've just seen a continued explosion of liquidity flowing into private equity. You've seen a continuing expansion of leverage levels and a continued expansion of purchase prices as a result. And I just think it's so risky and so dangerous, and it's just not worth it. But I'd say those ideas are out there, right? And you'll hear people talk about them. And I think most institutional investors will say, hey, we get it. We understand the risks we're taking. We know about the leverage levels. We know about these purchase prices. It's a risk. We factored it in. But what you don't see is any behavioral change yet. So investors are still equally as excited about private equity as they were 3 years ago, if not more excited. I don't know when that ends. I think one of my mentors said it's easier to know what will happen than when it will happen. I'm pretty sure I know what's going to happen because we've got all the seeds, right? You've got illiquidity, you've got crazy leverage levels, you've got excessive optimism, you've got a very small exit door if you want to get out of those things. All the ingredients for tragedy are there. But when it will happen, I don't know. And I think I've probably been calling it too early.
Well, I mean, I think it's shockingly kind of simple the way this probably plays out is that, you and I both know the people allocating to these sort of strategies, of the last 3-4 year vintages, I mean, you have a 10-year horizon on many of these funds, and the people that allocated, they're gone. They will very likely have moved on to a new position, retired, whatever. And so when the results start coming online, 2024, 2025, they'll be like, well, that was really stupid. Where's Jim? Or, it wasn't me. I wasn't here, the one that allocated. And so you'll see the behavior probably in like 3 years from now, where everyone will be like, oh, let's reallocate to something that makes more sense. It's not as expensive, but that's sort of the way the world works in that institutional world. So we'll see. I don't know. CalPERS still hasn't responded to my offer. I applied online to their CIO opening, and I said, I'm happy to do this for no salary, and I'll put you guys in a bunch of publicly listed ETFs and strategies, and we'll just meet.
You should just start running an annual tracker of how much better CalPERS would have done if they'd accepted that offer than whatever in God's name they've decided to do. I feel like it's just a comedy of errors over there.
I say we'll have one yearly meeting, and we'll have a few beers, and that's about it. But anyway, no response yet to my not even interview yet. So I'm going to be upset if they don't reach back out. Zero cost, CalPERS, if you're listening.
Well, I can come in with you every year to consult with you on the private equity portion. We'll have a beer and we'll say, Meb, should it be 0 again this year? And I'll say, yes, Dan. Yeah, yes, Meb, it should be. And we'll have another beer. It'll be great.
Yeah, we'll save them some money. Yeah, I don't know. I mean, the valuations alone. I mean, this was, I think, a pretty eye-opening insight. Dating back to your days at Bain, even where the value spread of what used to be what you were getting is not the same. It's like markets are always like, it's like a swarm of bees, right? They change over time, and sometimes private equity made a lot of sense because it was a lot cheaper, but that's not really the case in 2021. Okay.
No, I mean, I think that it's interesting, right? I mean, you think of these sort of big secular opportunities, right? And I think there's something that sort of defines them all, right? Which is that something is really unpopular and cheap, right? People are uncomfortable doing it. And so you're able to buy assets at a really low price, right? That's sort of what a lot of these sort of great trades of all time. And sometimes those great trades have been like, hey, right after the financial crisis, nobody wanted to own Microsoft for whatever reason. Microsoft traded dirt cheap, right? And Microsoft turned out great, right? But, private equity had that element to it, right? There was a time when these were alternative assets precisely because they were out of the mainstream, right? That 80 or 90% of allocators say, hey, we don't do that. We just do public stocks and bonds. We're not doing that. That's an alternative. That's weird, right? And when Cambridge Associates and the Ford Foundation, Harvard Management, and Yale in the early 80s said, hey, maybe there's some money to be made in real estate or unlisted companies or venture, right? They were doing something that was very uncomfortable and very kind of out there. And as a result, they were able to scoop these things up at just these crazy low prices. And it turns out if you can flip them to a public company or list them or just make them less weird and less unattractive, you earn a big premium for doing that. But I think the history of markets is not replete with a lot of examples of great trades sort of following what everyone else thought was the best idea and best practices, right? When everybody is telling you, hey, best practice is to put a very large percentage of your portfolio in this asset because it offers the best returns, right? That has not typically been the thing that's led to great outcomes. It just hasn't.
Well, there's been, somebody had a tweet the other day that was pretty good that, we all know what the returns of certain strategies have been over the past few years. And all of a sudden, every big asset manager, there's something like 40 funds filed with innovation or disruption in the name. And it's like, how can you be one of these shops and take yourself seriously chasing, as just the hot dot? I mean, it's the average public mutual fund, half disappear every decade. I mean, that's astonishing to me. They just go away. You guys were also talking about a market that was pretty out of favor that's now broken out for the first time in, I don't know, 3 decades, Japan. That was when you guys were early on, that's kind of played out. Tell me a little bit about what's been going on over there.
Yeah, so we've been really excited about Japan for a while. I think there's sort of some structural things we love about Japan. It's a really big market. There are about 3,000 listed equities, so almost the same number as the U.S., just kind of insane. It's the second largest, equity market in the world. Really, really cheap. Okay, so if you want to go buy, the cheapest decile of Japanese companies, you're buying stuff at like 3, 4, 5 times EBITDA. I mean, it's just astonishingly cheap. Right. And the cheapest decile, remember, is like 300 stocks. So you've got a very plentiful opportunity to buy just crazily cheap stuff. And I think the usual risk in Europe or the US that you face with buying crazily cheap stuff is that it's going to go bankrupt. So yeah, you can buy the Yellow Pages for 3 times EBITDA, but a year later, the Yellow Pages are out of business. But Japan has this kind of culture where they don't like bankruptcy. So basically, like, if you're publicly listed, you're going to be publicly listed forever. And the government and the banks and everyone's going to try to make sure a way to find you never fail because they have lifetime employment guarantees, and that's just not acceptable in Japan. So it's a really cool market to do small value, right? It's big, lots of selection opportunity, really cheap, and without the sort of downside risk of the bankruptcy that causes so much pain for small cap investors, growth or value, in the US and Europe and elsewhere. And you don't have to face, right? You look at the other countries that are as cheap as Japan, and you're like, Japan, Russia, whatever, right? And you sort of sit back and say, like, is Japan, like, how do I compare Japan and Russia on like the things I might be worried about, like corruption or like regulatory disclosures or the risk that my equity is going to be expropriated, or just like pretty much any possible risk I can possibly conceive of? I'm like, Japan feels pretty safe. And so why does it trade at these valuations? By the way, the UK is now getting into those levels too. So we can talk about that more, but the UK is kind of getting into those levels too, which is kind of crazy. But Japan has been there for a while. I think you're starting to see Japan break out. You saw Buffett invest, right? You saw Japan finally, the Nikkei is above 30-year highs formed in like 1989. And I think a lot of people are starting to say, hey, gee, maybe I should have some bigger exposure to the, second largest developed market in the world. Maybe that would be a good idea. And maybe it is pretty cheap. And valuations today, by the way, if you compare Japan to the US, it's an exact inverse of 1989. In 1989, the future was Japan. Japanese companies were the best run. All innovation in the world was happening in Japan. Now it's the US. All innovation happens. The US management style is better. The people outside of the US can't run companies very well. They're not innovative, right? Japan, it's hidebound. They run things the way they've always run them. It's boring, right? It's the exact inverse. And I think if you think about benchmarking what do the next 30 years look like, I'd be a lot more optimistic about Japanese equities than US ones.
I mean, that's the thing. I mean, it's so obvious when you talk about historical cycles. I mean, every country asset class has its time in the sun, and Japan is like literally the biggest example in every possible scenario. The biggest bubble in the 80s, and then literally 3 decades. I mean, I was sad to miss this past year. We do almost annual ski trip to Japan and get to hang out with some local investors and traders. We do a meetup in Tokyo, and you talk to a lot of people, and the culture of this buy and hold mentality for many doesn't really exist, because for their entire life, the market is essentially on a absolute basis gone nowhere. It's just been up and then down, sideways, recovering from this bubble. And so, I mean, again, as you mentioned, this isn't some tiny country or economy. This is top 5 on every metric, right? And so, you've had an entire generation, not just within Japan, but globally, where their hands have been burned so many times trying to buy something. And then by the time everyone's given up, voila, here we are. And it's just like this amazing opportunity. But that's kind of, like looking into the things that have been just beaten down over time is usually a pretty fertile place to search.
Yeah, and I think it's trying to anticipate, right? I think that our goal, both yours and mine, and I think we sort of think the same way. You're trying to anticipate these things before they happen, right? When there's going to be a secondary change, you want to get in first, right? You want to have deployed your capital, and then you want small value to rally. You want to deploy your capital, then you want people to realize Japan's an opportunity, right? You want to get in first, right? Because those secular shifts, when they happen, they can really start to run real fast. And so I think that you think, okay, well, how do I know about that, right? If I know that it sort of seems like every 10 years, everything I've learned over the past 10 years is wrong for the next 10 years, right? So how do I sort of know what to do if not relying on the last 10 years performance where I've learned all these lessons, right? I've learned all these lessons. And yet I have to now completely unlearn them over the next 10 years, right? And that's sort of the challenge to investing. I think so the only way to do that is to look at history over long periods of time and say, hey, gee, let's look at other prior histories of regime change and how some things start to work and then they stop working and something else works, and what are sort of the patterns and what can we sort of rely on? And I think there are sort of, a few, big things you can rely on, right? Like one is that, valuations, they do matter, right? And of course, a richly valued company, a country or company can get increasingly richer and more overvalued, right? And again, it's that idea of it's easier to know what's going to happen than when it's going to happen. But that when you buy that really expensive company or that really expensive country, right, most likely your odds aren't that good. And when you buy that really cheap thing, most likely your odds are pretty good. And then I think if you want to get beyond that of sort of the buy and hold attitude of constantly gravitating towards the cheapest things, the best opportunities, right? There's sort of a few kind of tools that I think I've sort of come across or read about or tried to implement. I think one of the most significant is understanding that a lot of these regime changes happen around recessions and crises when there's a reset, and I think that's been historically true, right? You just kind of look and you can demarcate the history of equity markets and what's worked and not worked by looking at these recessionary periods and saying, hey, did what worked coming in work coming out? And the answer is almost inevitably no. And so I think thinking about crises as sort of these moments of regime change, moments when the pattern that you're looking for as an investor, where history is going to tell you what to do in the future, it's just more reliable. It's a very helpful rubric. And I think one of the reasons for that is most people that aren't informed by long-term history are panicking, and they're pretty much going through a fire sale. And if you're keeping your head cool, and if you're saying, well, gee, March 2009 would have been a pretty good time to invest in the stock market, you're thinking very differently from the average investor.
Yeah, I mean, even think back to a year ago when everyone was spending every night looking at the futures again, and things on the screen were just, down, double digits on some days, and how you feel, right? So much of this is that squishy behavioral, emotional side. In 2009, those are pretty short crisis, certainly within the US, and then compared to something that's just as long and, unrelenting like Japanese stock market, 3 decades of just nothing, and how that weighs on your psyche, it's tough. Well, let's pivot a little bit to where the crises are even gnarlier and deeper, and seem to be happening, on average every year somewhere. You got a good quote from Tolstoy in the beginning, speaking of authors from that country, where happy families are all alike, but every unhappy family is unhappy in its own way. How's that a lead in for your new paper? When this one come out?
We just published it in February, so
congrats!
Psyched to be talking about it with you. I haven't done any talks on it or podcasts or anything. So
good. Well, let's get bloody. Let's hear it.
So we started thinking about crises, and where do crises happen the most? As you said, Mevin, it's emerging markets, right? If you think about investing in crises in the U.S., you get a few, you get a few at bats, or you expand that to developed markets, you get a few at bats. You expand to emerging markets, you're getting, pretty frequently. In fact, I think crises in emerging markets happen about 2x as often as they do in developed countries, right? So these are happening very regularly. And the other thing that's really interesting about emerging market crises, right, is that they are sort of precipitous drops, right? So, if you look back, in 97, 98, EM was down, this is just the EM equity index was down 50%, and the US market was basically flat, 97, 98. That was the big EM specific crisis. Then you have, 2000, 2001, right? S&P is down like 30%, EM is down 50%. Right, then 08, 09, S&P down 50, EM down 60, right? So when there's a crisis in the US or developed countries, EM is getting whacked even more. And then there are all these sort of idiosyncratic crises where some country just blows up for its own reason, right? And those happen all the time too. And so we got sort of thinking, well, if we've studied these crises in the US, right, we think we kind of understand them. What about our emerging markets, right? Can we go and look at what's going on in those markets, and how should you navigate emerging markets? And I think emerging markets weren't an area I'd really studied that much or spent that much time on, in part because I came from this private equity world where EM was very peripheral to private equity investment, right? Private equity was really a developed market phenomenon. So it was really kind of new to me, and I started digging in. I think it's been fascinating. So I think there's sort of a few really interesting things, right? So I think the first thing I was sort of shocked by, right, is, and I think if you think about, especially people who became investors in the 90s or the 2000s, there was this very strong consensus about emerging markets, right? Maybe sort of the same as the small value premium, right? There's a small value premium, there's emerging market premium. Why does the emerging market premium exist? Well, there's sort of this not mean reversion, I forget the term for it, but small, emerging countries, their GDP just catches up to the developed countries, right? And so you get higher growth in emerging markets, and that higher growth translates to higher equity returns, and you get paid to own them, right? And that was very much the consensus. I think that was like in the CFA or something, right? But certainly, right, anyone reading GMO or, worked at Cambridge Associates or whatever, right, the mainstream of finance pretty much agreed in those periods that EM was a super return opportunity. It was just a place you harvested an excess return just for doing it. And what's sort of fascinating is that just has been wrong. It just hasn't played out that way at all, right? So, I think if you look over the past 30 years, EM has returned like 5% a year with a 22% standard deviation. The S&P 500 has returned 10 with a 15% standard deviation. So you accepted like wildly more vol for really mediocre returns, even though emerging markets actually had GDP growth that was roughly 5% a year over that period, and developed markets were growing at 2%. So the sort of GDP thesis was kind of right, but the equity just didn't translate to equity returns at all. And so you start to think about, well, why? What happened? Where's the disconnect? And I think it's two things, right? I think one big thing is crises, right? You just had these wipeout moments where, say the Philippines in 97, the Philippines have never recovered. It's like Japan, right? The Philippine equity market has never recovered from its 1997 high. And that's not uncommon, right? So if you look at 50% drawdown, which again happen pretty frequently in EM and much more rarely in developed markets, your chances of recovering from a 50% drawdown, or like 90% in a developed market, right? You're investing in France, and French market goes down 50%. You've got a 90% chance you're going to be back up within a year or two, back up to where you started. EM, it drops to about 75%, right? So, your chances that you're going to recover, they're still good, right? It's still good betting odds, but there are a lot of these companies that just go bust and never come back, right? And that's a risk you're taking in EM. So that's been one factor. Very frequent crises that just wiped out gains and reset things, and there was bankruptcy and the slate got cleared, or the market never recovered and it was a big part of the index weight. And those things have been really detrimental to emerging market investors. And the second is sort of more conceptual, but relates, I think, to some great work that Perth Toll and others have been doing around property rights and legal protections and avoiding corruption and thugocracy and torture and all these awful things that tend to happen in some of these countries, right? And you think your equity might be fine in China, and then you see what happens to Ant Financial, right? And all of a sudden you realize, gee, maybe Chinese equity isn't all that safe. Maybe the property rates aren't all that good. Maybe I should be a little bit more worried. And that, if that's happening in China, which is now, I think there are some people saying, well, maybe China should be an emerging market. Maybe it's big enough that we should think of it as developed market. But certainly, if that's China, right, think about the next level down. And it's just, been mayhem out there. So I think broadly, EM returns have been pretty disappointing, despite great consensus among smart people that they were going to be really good, right? Especially, and I'll talk about why that consensus is sort of interesting, and we should go into that. But they've been disappointing. And the reason, I would say, has been these crises that are just wiped out folks and really driven returns way down. And so I think thinking about how to navigate those crises, what to do about them, is, I think, really important to investing well in emerging markets.
Thinking about emerging markets over the past 20 plus years, you have these periods, like almost anything. I mean, today it's innovation, disruption, and a lot of the tech companies. But looking back in SPACs over the last 20 years, every couple of years you have the new shiny object. And pre-financial crisis, the BRICS were hot. I mean, you go to any institutional conference, the FANGs were the BRICS: Brazil, Russia, India, China, right? Because in the 2000s, emerging demolished US stocks, partially because US stocks finished the 90s on the highest valuation they ever were, right? Rinse, repeat over and over again. And so these things go through cycles. And at least on the sentiment side today, the vibe, at least on, maybe it's more individual and retail, I talk about how I put my son's 529 and my 401k entirely into foreign and emerging, and people lose their mind, particularly when you talk about emerging, they go crazy. And you lay out some of the use case and say broadly, it's still attractive: valuations, demographics, the fact that everyone gets angry, and also that people are really underweight. I think Goldman had the average stock allocation in emerging in the US at 3% versus the, whatever you want to call the market cap, depending on how you weight it. But part of that, I think, is what you're talking about, which is you touch the stove enough, you're not going to go back to the stove, right? Like, you've burned your arms 6 times on the reputational risk of investing in Thailand or Brazil or Russia, Greece. My God. Greece, by the way, just half the time is in developed, half time in emerging. At some point, maybe in frontier, who knows? But talk to us about
to move into frontier.
Yeah, so you guys started looking how to think about emerging markets in crisis, and kind of where'd you come out the other end?
Yeah, so I think that this liquidity dynamic, map, exactly what you're talking about, right, is really important to understanding EM, right? So you think about, where does most of the money, for the last 30 years, most of the money that is going to fund company growth, right? Where's the money that's going to come in and buy public equity in these stocks? Well, most of it's going to be external, right? It's going to be someone in New York saying, hey, Thailand is interesting. I'm going to go invest, and I'm going to fund the new construction of a railway, right? This goes back to like the British Empire, right? And by the way, there were a lot of like fraud schemes, right? We're going to build a railroad in Panama, right? Give us the money. And then they disappear the gold mine in Colombia, right? And obviously it's not that bad today, but this is a long story, right? If you think about hopes and dreams that people have hopes and dreams that the world is going to become a popular science magazine, or that the thing that they watched, that last sci-fi movie, is going to become real. And they also have hopes that some exotic foreign place they've never actually been to is somehow going to become, a very robust and profitable opportunity they really want to be in on. And so you see these dynamics, right? And I think the other big thing that you have to look at, right, is that there was, for a long period of time, after the fall of the Soviet Union, there were a lot of there's a lot of politics about emerging market investing, right? There were a lot of people who are saying the Soviet Union has fallen, and the world, we're going to have a world that there's global convergence, right? We're going to have liberalization. We're going to have the globalization. We're going to have privatization, and we're going to see this convergence whereby all these developed markets catch up, the rise of the rest, and you should go put your money behind this, right? The World Bank is going to tell you, go fund the construction of that bridge in Thailand, right? And there were a few kind of interesting things about that, right? One is it drove a lot of liquidity flows into these markets. And those liquidity flows actually did drive economic growth. They were beneficial, right? The New Yorkers that funded the building of that bridge in Thailand, that bridge in Thailand actually paid off in GDP growth. Just the guys in New York didn't make any money off it. It was good for Thailand, just wasn't good for the investors in New York, right? So you had this huge push from people like the World Bank and others, and the sort of chattering classes that you had to be smart. You had to get your money into these emerging markets, right? And there's the old adage that emerging markets are something that's sold, not bought, right? It's sort of pushed on people. It's a good idea. All the experts say it's a good idea. And the other thing about that, though, is that when the crisis comes, right, and you're sitting there, well, I've never actually been to Malaysia, right? I know we have a 2% allocation to Malaysia. I've never been there. I know nothing about it. The one thing I read online said that the company that we own there is kind of shady. We should just sell it, right? It's down 50%. Let's just take our tax loss and get out, right? So you have these really exaggerated liquidity flows, right, where everyone's really bullish and then everybody pulls their money out. And that contributes to a lot of problems in these emerging markets, right? Yeah, like over the long term, foreign investment is good, but the volatility of that foreign investment causes a lot of problems for these countries. And there's a whole litany of macroeconomic issues that it causes. But one of the things that happens, right, and again, sort of similar to what we talked about with small value during crisis, right, is that emerging market, if you like small value in a crisis, you're going to really like emerging market in a crisis because the liquidity flows are even more dramatic and even more ignorant, right? If you think of that like small auto parts company in the US is unfollowed, right? It's sort of like Malaysian equivalent is really not followed, right? So if what we found, right, is that let's separate out two types of crises. So there's sort of, let's call them global crises, right? So the US, let's define that global crisis. Anytime the S&P 500 is down 20%, right? So the S&P is down 20 and Malaysia is down 50, right? That is a really good time to go buy emerging, right? Because the liquidity flows out of EM are not a consequence of something that's EM specific, right? It's not like the junta has just taken over and expropriated all the assets and you're a fool to put your money in, right? Like it's just that investors are panicking and they're selling the stuff they don't really understand. And that happens to be a lot of emerging market assets, just sort of a tourist investment for a lot of people, not a sort of core holding. And so, there are these fire sales, right? And so if you go and buy emerging market equity, especially emerging market value equity, I think that we found that over these emerging market crises, you were looking at, really dramatic. 2 years after a global crisis, the U.S. market was up, call it 25%. Emerging markets were up like 90%, right? So if you were willing to take the risk in March of going to buy March 2020 and going to put a ton of money into emerging market, that was a really good idea because everybody else was panicking, right? And all those same things we talked about with sort of the earnings rebound and cyclical GDP, right? Well, emerging markets tend to be they're sort of at the tail whip of supply chains, right? So they're providing a lot of the raw materials. And those raw material prices are going to fluctuate really a lot with GDP growth, global GDP changes. And so if you think that the auto parts manufacturer is really cyclical, the company that makes the rubber for the tires is even more cyclical. And so emerging markets in times of global crisis are supremely, they're perhaps the best place to do sort of extreme crisis investing, right? Risky, but extremely interesting. Then you have the idiosyncratic crises, right, where one country just blows up, right? Everything else is going fine, and Argentina just goes, parabolically down, right? Those times actually are a little different, right? So when we analyze those, what we found is that they actually only had about a 65% chance of recovery, which is really low. The equity market was only 65% chance. So for all crises, global and idiosyncratic, you were up at about a 75% chance of recovery in emerging markets. But if you just do the idiosyncratic ones, it drops to 65. So a lot of the times, if you go into these countries just after they've had a crisis, we define a crisis, by the way, as a 50% drawdown in the market, right? So, Argentina's going along, every other country is fine. Argentina's market drops 50%. No other country has experienced anything similar, right? Argentina only has about a 65% chance of recovery, right? 35% chance. The reason it dropped 50% is some awful thing that happened to the government or regime change or property expropriation, and you're just not going to get your money back. And so buying EM in these idiosyncratic crises is actually not that great of a strategy because those really low recovery rates, right? It's just too risky. The problems are often too real. and not liquidity driven, right? Which is sort of what you're looking for, right? They're the liquidity driven opportunities, not real information driven opportunities. But what we found was sort of interesting, right? And this is sort of a broad finding about emerging market. If you look at emerging market debt versus emerging market equity, over the past 30 years, you've done better in emerging market debt than emerging market equity with half the volatility. And specifically, if you went and said, okay, Argentina, for whatever reason, is down 50%, no one else is down, I'm going to go buy their government bonds. That's actually been a really good trade, right? Because you've recovered in the government bonds a much higher percentage of the time, like 85% of the chance you're going to get your money back. And often the returns are going to be very good because you can buy like that debt at like 20 cents on the dollar, 30 cents on the dollar, 50 cents on the dollar. And when it goes back up to par a year or two from now, maybe they got a bailout, maybe the economy just recovered. Even if the equity market didn't recover, most often your money got on the bonds, and there's often a lot of upside because we're able to buy them below par. So we came up with this idea that, in this emerging world, right, you have this sort of buy and hold approach. And we sort of said, hey, gee, buy and hold has not actually been that good, in part because these crises and the liquidity issues we've been talking about, these boom bust cycles, it's just a crazy kind of headache that hasn't ended up paying off. But if you were more like a sniper approach, right, you just wait, and you wait until there's a crisis, and then you say, okay, gee, first question, is it idiosyncratic or is it global, right? Is the reason that this Malaysian market is down 50% because investors in New York are panicking about everything? Or is it because something really bad happened in Malaysia and only Malaysia, right? And if it's the former, right, if it's a global crisis that's liquidity driven, go buy equity, go buy emerging equity and buy as much of it as you can. You're probably going to do really well making that trade. And if you can buy value, because emerging market value does even better. And if it's not, right, if it's just specific to that country, don't take the risk on the equity, right? Because you might not get that money back. It's a 45% chance you're going to lose more money, even though the market's down 50%. What you're better off doing is buying the debt. And that's often a very good trade and much more likely to come out ahead. And so what we sort of said is, gee, that approach, right? Let's say you just sit in 10-year US treasuries or sit in cash, and you just wait for crises in emerging markets and draw down from that sort of central bank to go deploy capital in emerging market crises. That's dramatically outperforming the returns that you would have had buying and holding in emerging markets. And it's a relatively simple approach.
Yeah, well, simple are my favorite. And I think people can think back just even over the last decade, a couple of things that I imagine listeners are mulling over. I mean, they may say, well, debt, that sounds so boring. That's not going to have, the juice. But there's been if you think about Greek debt post financial crisis, I mean, that was like a Mount Rushmore trade. Like you made that trade, you bought Greek debt, you don't have to do anything. That was like a career maker post GFC. I think the struggle a lot of people are going to have is say, okay, what do I do about the timing? How do I go about putting this together? If I wanted to think about this, is this something that I'm looking at every day? Am I updating this once a year? How do I portfolio size these things? Am I just going all in on whatever's down the most? How do you think about putting it all together into a coherent strategy?
Yeah, well, I think part of it is developing some simple, intuitive rules for thinking about EM, right? One really simple, intuitive rule, right? It sort of builds on our work in small. Okay, so let's talk about market timing maybe for a second, right? So market timing is this really dirty word, right? In part because a lot of the time when people talk about market timing, they're saying, hey, I think there's going to be a crisis. Let's sell out now. Right. And that type of market timing has just been a disaster for people. Right. And then there's a second type of market timing where the market has just blown up and you say, wow, we're about to enter the Great Depression. Let me press sell. And that's worked even worse. Right. So those are the two types of market timing that are really, really bad. Right. And really destructive to investor portfolios. Now, part of the reason that those are both really negative, right, is that they're built on sort of this fear-based narrative, pessimism in a sort of the triumph of the optimist world, which is equities, right? The other approach, which I actually like and I agree with, and I know this is heresy to talk about market timing, but I do believe in, right, is in times of crisis, you're in a crisis, right? So it's not like I I think a recession is going to come next year, right? Well, you don't really know that, and the probabilities really aren't that good. But when you're in a crisis, you 100% know you're in a crisis, right? It's on the front page of the Wall Street Journal, right? Like your grandpa's calling you and saying, should I sell all my stocks, right? Like, it's just really obvious. So it's natural to say, hey, when there is a crisis, I want to have kind of a playbook, right? I kind of want to know what the most likely things that are going to happen next are. And if I'm an optimist, not a pessimist, what should I be betting on, right? How should I be thinking through this? And I think there's sort of a hierarchy, right? You're sort of sitting there and you say, okay, where should I look? Now I know that we're in March of 2020, right? I'm sure we're in a crisis. I'm sure everything is going to pieces. What should I be thinking about? What should I be going through my mental checklist of opportunities? And I think this piece, this emerging market crisis paper that we wrote, one of the big things it highlights is emerging markets should be at the top of your list, right? You should be thinking if the S&P is down 20, right? I should, there's so many people, right, that have that buy list. They're like, okay, Amazon is a company that I really want to own. So if Amazon ever went down 20%, I would buy it, right? And you're sort of saying, if Amazon is down 20%, right, you should be pretty confident that like the Indian stock market is going to be down like 60. And you're actually going to do much better going by the Indian stock market than you are going and buying Amazon. So I think that's a really good sort of checklist. So, you're in a crisis, you should think emerging market and especially emerging market value, right? Because the value stuff, for the same reasons in the US, the value does better than growth. And then in the US and developed markets, small value, right? Those things are the things that tend to rip very reliably out of these global crises, right? So I think if nothing else, that's sort of the key sort of simple takeaway, right? That in crises, if you want to earn excess return, you're in a crisis, you have cash to deploy, God willing, right? Go buy EM value, go buy small cap, especially small value, and you're going to earn a lot of excess return for taking on a lot of risk and for very rational liquidity-driven reasons, right? There's liquidity flight from emerging markets, there's liquidity flight from small value. You're able to buy stuff that other people are panic selling for no good reasons other than that it was a tourist, non-core investment in their holdings and they're trying to liquidate. So that's, I think, the first takeaway, right? Which is sort of simple, very high level, sort of heuristics level. Then I think there's where it gets kind of complicated, where it's a little bit more difficult is sort of thinking through these idiosyncratic crises, right? Where, Malaysia blows up and nothing else blows up, or Chile blows up and nothing else blows up. And what do you do? And going and buying Chilean debt probably isn't something that a lot of us are going to do. That's probably something that, you're going to have to hire someone to do for you if you want to do it. I think it's a pretty interesting trade, but it's probably too complex for a variety of reasons to do at home. But I think for anybody, you can go buy EM value stocks in the middle of a crisis, and that's sort of the most simple and most obvious answer.
A lot of these individual countries are even more bananas. You mentioned Argentina amongst others, but there's the old investing adage, what do you call something down 90%, something down 80, and then went down by half right afterwards. And so that 50% marker sounds like a lot, but in some of these, I mean, my God, if you look back at the history of the last 10 years, I mean, Brazil essentially went through like a Great Depression. Greece is essentially fallen into the Mediterranean, yada, yada, on and on, right? Should most investors think about it, like broadly speaking, as you mentioned, emerging value? Should anyone dabble into these individual countries? Yes. And then lastly, you got to throw this all in the bowl of cereal is, how should they think about currencies in this mix too? Should they hedge them out? Should they not hedge them out?
Yeah. So emerging markets. So this is actually really cool. There's a professor at Yale, William Getzman, who there's a company called Global Financial Data. And what Global Financial Data does is they string these really long time series together, right? So like you can look at the Mexican stock market back to 1700, or the US, the UK stock market back to like 1400, right? It's really cool how they do it. And Will Getzman at Yale went and said, gee, like I know there are a lot of research on bubbles, but what about negative bubbles, right? What about times when markets blew up and there was a panic? Were those good buying opportunities? And what Getzman found, looking at, I think his data set, his analysis started in the 17th century. So from like 1690 to the 2000s, what are sort of the empirical realities of these negative bubbles, as he calls them? And what he actually found, to your point, is that it wasn't a 10% drop was not enough, right? Like 10% drop, it's almost like that's more of a trend following moment, right? It drops 10%, like maybe you should sell. Drops 20%, maybe you should sell, right? There's sort of a trend dynamic there, right? But But once you hit 50%, that was sort of the magic number in his research. Once you had 50%, you had what he calls a negative bubble. And negative bubbles are such attractive buying opportunities. And for many of us who are, long only or long biased, right, what you're really looking for is negative bubbles, right? How do you deal with a positive bubble? That's another, can of worms, but you sort of know what to do in a negative bubble, right? It's sort of what the rational, historically minded, thoughtful person knows, right? When something blows up and blows up way more than it should have, you should go buy it. When people are panic selling, when there's blood in the streets, that's a good time to buy. And I think that Getzman found that that's over a very long period of time, like back to the 17th century, the right answer. So that 50% threshold is, I think, a really important one. And we sort of looked at it two ways, right? We looked at creating an index of countries based on which ones were down 50% or more, right? Or by just buying the emerging market value index. And it's the same outcome. They basically own the same stock. So they're sort of indistinguishable, right? But I think what you want to be cognizant of, right, is just making sure that sort of global versus idiosyncratic crisis concept is I think, important, right? If your favorite market is down 50% and the US market is down 20%, by all means load up. If the US market is chugging fine and your favorite market is down 50%, you should have a second, step back and say, hey, wait a second. Maybe there's a pretty good reason for this. Maybe my odds aren't as good here as they would be if the reason for the down 50% is that there's a global liquidity crisis, not that there's some real specific informational content about what's going on in this market. And I think, another way to sort of think about that, right, is often there's a down 50% after a big bubble is burst, right? So down 50%, in an idiosyncratic time might actually just be sort of coming back to fair value from a really exaggerated overvaluation driven by foreign capital inflows pumped up by promoters in the US.
And a lot of this, it's kind of getting at the same concept from different angles that I think is really thoughtful. The cool thing you mentioned, the Global Financial, we had the founder on the podcast. I think Brian's coming back on, but there's plenty of other sources of free research if you're listening, listeners, like French Fama data. We'll add a show note link. We have a post somewhere, I forget where, that lists a bunch of free data sources, but you can take a lot of these back to the 20s, maybe not to the 1700s like the professor. But the cool part is that you can examine a lot of different ways. We have some old studies that are like a decade old. I mean, in my first book, and these are like kind of like magazine cover sentiment style. So we just said, you got a big asset class. What happens when it's down multiple years in a row, like 3 years in a row? With the theory being is that people are so sick of opening their statements after a couple of years that they're going to sell, but also you're just getting this mean reversion of fundamentals probably. And so not surprisingly, the returns were great. Ditto if you buy things down 60, 80, 90%. And you got to adjust this, of course, listeners, if you're buying a tiny industry or a tiny country like Czech Republic versus buying, say, emerging markets or something like US debt. But the whole thing comes with like the close your eyes, hold your nose sort of concept, to where it's probably going to feel nasty. And it may go down even a little more, but often that's been rewarded over time. And a simple way to do it, if you're not that brave and bold and crazy as Dan, is to simply just rebalance, right? That naturally gives you the moving back towards center on whatever you're allocated to. No one knows any emerging markets anyway, but if you did, it would be moving back. Forex, how do you think about that? Do you think about it?
Yeah, I think that, generally, obviously the Forex is really volatile in these countries too. But, the rates that you have to pay to hedge some of these EM countries are so prohibitive that ultimately you just sort of stuff it and take the local FX exposure if you're buying at the right time. Because otherwise, you're just paying too much and it hurts your returns to try to hedge.
Who is getting incinerated? Do you guys run this as a strategy, by the way? Is this something you guys are putting to work?
We don't today, but I think we'd like to implement it. So we're working on that, and we think it's a really interesting approach. And I think the challenge to it, right, is I think you have to sort of pair it, right? I think that a lot of this crisis investing, if you think about it, right, it's like, oh yeah, like it's a great thing to invest when the market's down 50%, the US market's down 20%. The problem is, who has the cash? right? Like, right? Like, where's the money going to come from? Because when the market's down 20%, a lot of people are feeling a lot of pain, right? And there's a liquidity crisis for a reason, which is like, hey, everybody's sort of withdrawing money, right? So how do you kind of have the capital ready to go? Or how do you have capital that you were really conservative with in good times, such that when that tremendously good opportunity happens, you're the one with money, right? I think of Seth Klarman as sort of like my mental role model here for this, right? Like, if you think about Seth's career, right? He's had long periods of time where he's dramatically underperforming the market, right? The 90s are a great example, right? Klarman is just getting crushed, right? He's up like 2 or 3% or whatever, right? And the market's up like 60, and people are saying, like, why are you buying tech stocks? What are you thinking? And he's like, I'm 40% of my portfolio in cash, right? And then the market blows up, right? And you get this sort of like once every 5 or 10 year opportunity. And Baupost is going deep into value stocks, deep into distressed debt, right? I don't think they do international anymore, but like, you know, you think about that type of approach, right? Where you sort of say, hey, what I want to be doing is sort of something really conservative when everybody else is exuberant, right? It's the Buffett quote, right? Like, how do you actually implement that? Like, what would you actually do that would be conservative, such that when everyone else had a 30% drawdown, you had a 10% drawdown, and you hadn't been paying out massive hedging costs in the interim, such that when these emerging market opportunities presented themselves, you were the one with cash, right? And so what I've been sort of thinking about, right, there's sort of 2 ways to do that, right? You can sort of say, hey, I'm going to tell you guys all about this, and like, give me a call when the market blows up, and I'll help you put your money to work in EM value, right? Which is one sort of approach that makes sense, and we've done that in U.S. small value, and I think that's a really great approach, and it works. But I think the other way, and maybe the way better suited for the EM opportunity, is trying to think about some way to be counter-cyclical, right? To be conservative when everyone else is excited, and like Klarman, be really effective at communicating that that's the purpose of what you're doing, right? Like, there are extraordinary market opportunities. Negative bubbles create extraordinary market opportunities to create like generational wealth. But you got to have the money to deploy at those times. And those are the times that no one else has money, right? So, you know, you sort of think of why you're being rewarded. And I love that thing that you did about the 3 years down, right? The 3 years down thing, it's so brilliant because it's marrying psychology. It's people looking at their statements, and you're just thinking real world, like, oh, that investment committee I'm on, or like my own money, like that thing, like it's down 1 year, you're like, okay, 2 years, you're like, oh my God, 3 years, you're like, my thesis was just wrong. It was wrong. Like, I can't just revisit my thesis and ever imagine that I can tell somebody that my thesis was right, right? Clearly, my thesis is wrong. It's been down 3 years in a row, right? There's a real psychological impact there. And I think these negative bubbles are one of those classic examples where you can capitalize on that. And the opportunity is real. And it's real for psychological reasons. It's you just think common sense, of course it's real. And then if you pair that with illiquidity, right? And you say, hey, let me look for the markets, again, where people are tourists, right? Their core holding, no one's core holding is emerging market stock. No one's core holding is small cap value stocks, right? They have a 5% or a 10%, or if they're really adventurous, a 20% weight. But that's not stuff that they feel core to what they're doing. And as a result, when they have 3 years of bad statements, they press the sell button. And if you're there with capital when no one else is in these tourist investments that are actually good investments, but you're the one with capital to buy them after those 3 years, after the drawdown, you're going to come out ahead for very logical, very rational reasons that I think are very much in line with both academic research and market psychology and lived experience. But you got to have the capital. And I think thinking through that problem and how to do these things, whether to do that in an opportunistic way with drawdown vehicles, or whether to do it sort of in a full cycle approach like Klarman, I think those are sort of really interesting questions. But they get to the root of, you know, what makes investing challenging, right? This sort of psychology, the nature of cycles, and the challenge of finding a counter-cyclical way to deploy capital, which is just much, much harder than it seems on paper.
I have a better solution, Dan. Are you ready?
Yes.
All these big institutions peel off their private equity deals as they get liquidity, and they just put it in a sidecar and they reallocate into emerging market crisis. I mean, come on.
No, this is, Mevin, I know you're half joking, but maybe more to the point, right? Because this comes back to my original thesis about private equity, right? And one of the things I found really early on about private equity, which is really fascinating, is private equity capital deployment is very pro-cyclical. And if you think about why it's pro-cyclical, and by pro-cyclical, I mean they invest more when the market is expensive and less when the market is cheap, just sort of the opposite of what you want to do, right? And so your capital calls are like correlated with the S&P 500, right? The S&P 500 is ripping, you're getting a lot of capital calls. The S&P 500 drops, your capital calls drop, right? It's pretty crazy. And you're like, wait a second, right? Like, shouldn't a rational investor deploy more capital when things are cheap and less capital when it's expensive, right? And because private equity is taking money and putting it in things, right? It's not like the stock market where it's buy and hold and you're looking at sort of liquidity flows in and out, right? It's literally like they're calling capital, right? So you can really trace that. And one of the reasons for that, right, is that when a private equity firm goes and buys a company, they're putting a third or 40% of the money down and 60% of it's debt, right? So they need the lender. The lender has to be there, right? So if you're in the middle of a liquidity panic, well, what's the lender doing, right? That's the high yield spread. The lender is saying, no, absolutely not. I'm funding that. If you want the debt, you're going to pay 600 bips over, right? And the private equity firm is like, oh, that doesn't make the economics of my deal work. My deal only works when I get cheap debt. If I have to get expensive debt, then the lender's going to make all the money and I'm not going to make it, right? So if you look at how cyclical PE deal, and by the way, the private equity firms, remember, they always talk about the importance of control, right? We control our companies, we sit on the board. Well, what that means is when, crap hits the fan, right? All your deal team is going into the company they bought 6 months ago to try to save it, right? They're doing like weekly cash flow things for the management team and like, how am I going to meet my debt covenants? And gee, let's get our capital markets person to call all the private credit people to say, do not, absolutely do not force us to pay interest this quarter, right? So, right, all the private equity firms, they're totally distracted by their portfolio and there's no debt. And by the way, like, think about, you've made this really awesome company. It's your family's legacy. You know it's a great company. It has like 20% return on assets, and it's just a killer. And you decided, grandpa just died, you're going to sell it. You called up KKR, you called up Goldman, they ran an auction, right? And then all of a sudden the S&P 500 pukes 20%, 30%, right? We're sitting March 20, right? What family? What reasonable person is going to say, hey, should we hold off on the sale process, right? Like, maybe we're not going to get a good deal from KKR in March of 2020. Maybe we should wait. Let's just push the sale, push the auction back, right? So all those dynamics mean that allocators who are relying on private equity for a large component of their investments are having massive pro-cyclicality in their cash flows. And that's a problem. And what they should be doing, and I think to your point, which is totally dead on, right? They should be saying, hey, public markets are really uniquely attractive relative to private markets at these times. And even if private markets were attractive, I can't put any money to work there because there are no deals being done and no capital calls. So if I want my capital deployment to be steady and not take dips when an equity market takes dips, I got to find a way to plug that hole. And I think thinking through whether to do that with small cap value or private equity replication, which I think is a fantastic idea and one we've implemented to great success, or I think even to take the risk level and hopefully the return level to the next level and do it in emerging markets, I think it just makes so much sense. Now, can we convince people to do that? It's rational, it's logical, but I think the challenge to it probably is that you've got to find people that aren't so constrained by their style buckets, where they say, I have a 20% allocation to private equity, and public equities are not private by definition, and therefore absolutely not. But I think people that are a little bit more creative and saying, well, what I really am thinking about is drawdown vehicles as a type, or I'm really thinking about, lock-up vehicles as a type, whether that's public or private, and maybe distressed debt fits in. And, I think a more sort of holistic or creative approach would work. And I think it would really improve the results for, again, I don't think people should be allocating a lot to private equity, but if you are allocating a lot to private equity, you've got to be aware of this pro-cyclical problem and the fact that your capital calls really dry up in times of crisis.
I think that's really important, instructive on a couple of levels, thinking about, we talked a lot today about flows, but also about structural and behavioral reasons why these things can reinforce. And on the flip side, back when we did these old studies, and again, they were meant to be simple, but when you looked at the big asset classes, we're like 3 years down a row. But when you expand it to countries or industries, much smaller, much more volatile, you had some that could end up being down 3, 4, 5. There's only one industry in the history of the database that I remember that went down 6 years in a row, and it did it twice. And that's coal stocks. And this happened a few years ago. And more interestingly enough, the only way to invest in the coal sector was a coal ETF, which just closed. So it's probably a good time to look into this. It's an absolutely abandoned asset class, right? Totally uninvestable from
I don't
ESG,
know.
everything.
There's nobody wearing a blue shirt in a room with no books in it that owns coal stocks.
Yeah. You guys need to watch this on YouTube because Dan's waving his hands. Uranium was another one, and we
in that thesis.
We used to do these end of year comments where we say, look, what's been the absolute most hated thing, whether it's years in a row or down the most. And, it's been a lot of the commodities sector. It's been a lot of the ag sector. But by the way, I spend way too much time with my hands in the dirt in the farmland and ag world. But the things seem to be picking up there, whether it's due to inflation, whether it's due to macro things going on, might be an interesting place to look, listeners. But emerging also seems to benefit from some of these dollar and inflationary commodity moves that we've been seeing.
Absolutely. I feel kind of bad because I wrote this thing that, I feel like most of the stuff you read about EM is like very promotional, right? EM is the best, global convergence, right? Global privatization, liberalization, right? And I wrote this whole 50-page thing. It was really kind of dark about emerging markets. It's sort of like, I don't know, emerging markets kind of, over the long term, buy and hold there, it doesn't work. And I feel bad because I published it at the time when actually the whole paper was saying buy emerging markets, right? So it's got sort of like this whole tone of like, hey, be really careful, these things are bad. But I published it at a time when actually I think emerging markets might be one of the best opportunities out there. I'm like, you sort of rank the value opportunities out there right now. You sort of like, you're like, okay, I think probably Japan, probably the UK, and emerging market stocks. Those are probably like the big three for me right now. And then I think you've got the sort of small value recovery in the US. And those are the trades I think are really interesting right now. But it's sort of ironic that I published this hugely negative piece about EM at a time when I actually think it's an awesome opportunity.
Well, you're not going to have to wait long if you're waiting for a crisis somewhere in emerging markets. Yeah, exactly. Usually something is going off the rails. So listeners, you want to fund Dan's new emerging market crisis strategy? He promised he would give listeners the show a discount on the carry. So if you give him 10 million, the problem is the 10 million minimum. So hit him up after this and reach out. Dan, as you look out to the horizon, you guys have been cranking out research. What else? Anything else on your brain that's got you, thinking? Your sleep deprived new child brain that you're thinking about, brainstorming about, curious, worried, excited about? Anything else? Give us a sneak peek.
I think it's really the questions we've been talking about today, which are really, if you think about coming from private equity and moving to public markets, right, and saying, okay, well, it's private equity. You just kind of construct it with leverage and size and value, right? And then you realize you got to kind of start doing it. And you're like, holy smokes, the public markets are volatile. And then you're like, I personally am a really calm person. I don't get like really anxious. So like market's really volatile. It doesn't really affect me, which is nice. But I see how much it affects other people, right? and then I'm like, okay, gee, there must be something to this volatility thing, and start researching like cycles, and crises, and boom bust. And you start to realize this sort of excessive volatility of markets is just like one of the defining things you have to know about equity markets. You have to know, and you have to think through how that affects people, and how that affects investors, and how that affects investment. And I think this whole question has become so fascinating to me of like, if you know you have a good idea, right? You have this idea and you know it's right. And it's a question of, it's the what will happen, it's much easier to know what will happen than when it'll happen. And you're trying to figure out the when. And I think that the volatility of markets really is something that helps you think through the when, right? And trying to conquer the when and the market timing questions. How do you think about the relationship of that to macro? And how does that relate to crises? And then, going back to those times when there's not a crisis, right? I actually think the crisis playbook is pretty straightforward, okay? I think it's pretty obvious what to do in a crisis. And these things are pretty predictable, right? Like, and academic studies will tell you that, my work will tell you that, your work will tell you that, right? Like things are down 3 years in a row. It's just a pretty good idea. The hard part is actually doing it and finding the money to do it and having the money to do it, and taking that psychological leap to do it. And so I think that's the sort of set of questions I've been working through. Exactly what we've talked about, right? Like, how do you have the capital to go and exploit this crisis, right? Where does it come from? What should you have been doing with it when you were waiting for a crisis that didn't just like burn a hole in your pocket because you're buying like waffle hedges that didn't make you any money or something, right? Like, what's something rational to do that's conservative? And then, how do you then go and mix and match some of these interesting crisis opportunities? How do you match emerging markets and small value? How do you size them? All those things have been really the things that I've been thinking about. And I think it's all sort of, I'd say if there's, phase one of sort of figuring out what made private equity work, and then phase two is sort of figuring out how to deal with volatility and booms and bust cycles. And I think now I'm really interested in, pairing those two things also with some sense of understanding the macroeconomy and how volatility relates to what economic regime we're in, how the economic regime we're in relates to how small value does. And I think that's a lot of what's been occupying my mind. And hopefully, if you're a subscriber to my weekly research, or hopefully in 2023, when I come back on the podcast, we'll be able to talk about some interesting findings in those regards.
You'll probably have 3 more children by then. We'll be doing it by hologram, and hopefully some books on the bookcase, listeners.
Exactly.
A single book on his bookcase. So send Dan some books. One last comment. I think that, we talked a little bit about this, but I think is important. So many investors, when they think about topics like a new asset class or when to allocate, they stress so much about wanting to be all in or all out. Like it's as if it has to be this single binary decision. And we often tell people, look, you can think in terms of a spectrum of position sizing. It can be small, you can scale in, you can scale out. That's more boring for a lot of people because they don't have something to cheer for. But in many cases, I think is a thoughtful way to go about it, so that you're not, as we know, dealing with regret minimization all this time of, hey, I bought Argentina and then it went down another 50%. Damn it. Why didn't I wait? Or whatever it is, so maybe think in terms of units, bought a half unit. I can buy another half unit based on these rules. Anyway, things to think about. Dan, where do people follow you? Where do they go to keep in touch of all your emails and new research pieces coming down the pike?
Yeah, I'm on Twitter at verdadcap. You can go to verdad.cap.com, and both those places have sign-up lists for our weekly emails to come out every Monday, and promise that they are provocative, if nothing else.
Awesome, Dan. Thanks so much for joining us again, buddy.
Thank you, Matt.